Okay, hey, Ryan Hartman here with James D. Piazza, the founder and CEO of Bond Street Mortgage. And today we're going to jump right in with some great content for you here on our first time home buyers webinar. So whether or not you're a first time home buyer or you're buying a home again, I think you're going to find some of the information here to be really useful. How you doing, James?
Good, Ryan. How are you?
Great, great. So let's jump right into the table of contents. And we're going to run through what we're going to see here. We're going to be first talk about getting pre-approved for a mortgage. A lot of people don't realize that that is actually the first step in the process. And if you're already out there searching for homes online, of course you're excited. You might be doing it backwards. Then we'll get into some nitty-gritty hacks and things to know when it comes to searching for a home. I think you want to hang around for that part because you might hear some tips in there that could help you get a better deal on the property when you buy it. And then we'll go briefly into some of the things you can expect as you go through the transaction. You might hear from your friends or relatives that buying a home is a stressful process. And James, I think you would agree that it's a lot less stressful when you know what to expect.
No question.
Yep. So let's go on here to our next slide and let's talk about getting pre-approved for a mortgage. James, I'll let you have at it. Why is it so important to get pre-approved before you search and find a house?
I think the most important point there is understanding what you would like to pay on a monthly basis, what you can afford as it relates to your financial budget. So most people, which I think is a very good thing, come to find that they qualify for a lot more than they want to pay as far as a monthly payment. And so they're typically looking in a house price range that they may qualify for, but it's not what they want to pay. And having that discussion about those numbers up front then allows us to speak to your agent or recommend an agent if you don't have one to find the homes that fit that general area as far as purchase price is concerned that you should be looking in.
Right. A lot of people get overextended because they hear a number that they're approved for and they try to hit that number when it's really not the best idea.
Exactly.
The other reason I just want to touch on too here is because I see it a lot. I used to have a real estate license. A lot of people will be disappointed that they find a house they love and then they go to put an offer in, but the financing's not in place and they get beat out by another buyer.
Yeah, I don't know about you, Ryan. I do know, but for most people, right, you're busy, you're working, you have family things going on. It's really hard to find time in the day and forget about, a Saturday or Sunday to go look at 7 houses that you can't afford or you don't want to pay that much for a monthly payment. So to have that conversation up front, it's great to look at properties online. And I always say that to prospective clients, if you're seeing something online, send me the link. I'll be glad to, break down the numbers, do the research. As great as, some of the websites are out there, the Zillows and Truly of the world, many times I find they have the wrong information for taxes. They're not factoring in things like mortgage insurance or home insurance. So you're looking at a $500,000 house on Zillow and they say, wow, you can have this house for $2,000 a month. Well, that's not always the case. And the assumptions they make don't necessarily fit within your budget for down payment, for example.
Yeah, it's a really good point. I know that a lot of real estate search sites will actually underestimate that number to draw you in and get you connecting with the agent. Just a little insider tip there. So
yeah, unfortunately, they relate it to like the car commercial, right? You can have the big Mercedes for $399 a month, but then in the fine print it says with $15,000 out of pocket.
Yeah. And sign your life away. All right, well, let's go here now into the nitty-gritty of getting pre-approved. I think knowing this information will help people kind of get their ducks in a row now. And of course, when you talk to them, you'll be able to guide them through these things that are needed. So in terms of employment, what are you looking for, James, to get somebody pre-approved?
So obviously, we want to see a 2-year job history, right? That's important. It doesn't have to be the same job, but as long as it's typically in the same line of work, that's considered stability of employment. If you are coming out of school and, for example, you went to law school and now you've only been employed for 6 months with a law firm, that's fine. We really want to understand your employment picture for the last 2 years. And if that includes schooling, then that's part of that employment history, let's call it. So, there's different types of employment as we're looking here, a W-2 employee compared to a 1099 or self-employed. Unfortunately, being a self-employed individual, you're right in saying that, a W-2 is seen as more stable. I will argue that feverishly, but that's really how underwriting guidelines look at it. If you're employed and you have a steady paycheck, then that income is seen more stable. If you're self-employed or an independent contractor, then we must have that 2-year history, or at least going to look at a 2-year history of income. There is the possibility of, if you're in that self-employed position or that independent contractor position for 5 years and can demonstrate that, then we can use the most recent years of tax returns to qualify.
Right. And you do, for anybody listening who is self-employed or 1099, you happen to do a lot of those deals, right, James?
Yeah. And the other side of that is also for self-employed people, we can qualify on bank statements as well. So those programs are coming back, and, with 30-year interest rates and the conventional market have been rising. So that spread has been compressing where, maybe literally 60 days ago, a 30-year rate was 3.75, and now we're approaching, 4.25. The self-employed rates are in the high 5s, low 6s. So obviously that spread has come in a bit. And I do think, I've said it in the past, I think they will come in even more because the self-employed product for, bank statement type loans historically have always performed well. It's we got into the financial mess, of course, when they allowed those type of programs for the wage earner, where you're on a fixed monthly or weekly or semi-monthly paycheck, and looking at other means to qualify for the loan. So those are good things, and they are coming back. And so the basic things that we look at in qualifying when it comes to income is the debt to income ratio. Okay. And there's something that's called the front ratio, and there's something that's called the back ratio. And I follow, I always say I'm the dumbest guy in the room. So I try to, simplify it into 5 key points. Okay. Income, credit, assets, collateral being the appraisal, and legal, inspections, contracts, title. Okay. From the qualifying employment and income perspective and credit, the front ratio is simply the total payment, including taxes, insurance, mortgage insurance, if you're putting less than 20% down, or an FHA loan, divided by your gross monthly income. So if you make, like in this example, $72,000 a year, that's $6,000 a month. The payment is $2,000 a month. That's a 33 front ratio. Okay. The back ratio is calculated off of the total monthly payment, estimated payment, plus all of your revolving or installment liabilities like student loans, car loans, anything that would report on a credit report, divided by that gross monthly income. So you have a $2,000 estimated payment plus $1,000 of debt, $6,000 gross. Your back ratio is 50%.
Okay, you're getting a little technical for first timers, but the rough rule of thumb would be there are ratios that the mortgage company that you'll use to qualify somebody, and you'll basically allow them to have a housing payment of about 43%, or housing payment plus debt.
And again, from experience, when I especially talk to first-time homebuyers, the guidelines allow us to exceed those ratios, right? And there should be compensating factors for that. I personally, don't feel comfortable if somebody's coming to me on a steady paycheck and looking for a mortgage payment to exceed that 43 to 45% range. Because again, we're using your gross income. So if you make 6,000 gross, you're taking home what, 4,000 gross if you're lucky. So to have a mortgage payment of $2,000 a month, you're actually already at 50%, of your net income without even, saying boo for things like utilities, maintenance, and your other monthly payments that you may have. So I believe in the American dream, and I believe in, you know, that first purchase, and understanding, you know, your budget is very, very crucial to the home buying process. Owning a home historically, and we're getting there back to normalizing, is a vehicle to create wealth and sustainability financially, and it's you know, so I really like to talk and focus on that. Now, if you are 1099 and self-employed and you write things off, and you know your cash flow is very good and your liabilities are low, and because Fannie Mae or HUD says this is the way we must calculate income, and that ratio tends to then be higher, then we can take a more common sense approach to that. But if you're on a fixed income, I really like people to think about not exceeding that 43 to 45% of their gross income.
Right. You're probably going to be a lot more comfortable down around 20, 25% if you can find a house that fits that, right?
Yeah, honestly, 35 to 38% really is really the comfort zone. And I'm, you know, very pleased that most first-time homebuyers I taught today are thinking in that range. And quite frankly, because rents have gone up so high, you know, many people today want to keep their housing payment around where they're, you know, paying rent today, and they just say, well, I'm paying $1,800, I'm paying $2,000 a month in rent. I'm tired of, you know, paying somebody else's mortgage. I feel like I've been renting for, you know, 2, 3, 4, 5 years. I'm okay with that payment. What does that mean for me as far as a house goes?
Gotcha.
So they're not looking to overextend what they've already been paying, you know, over the last few years in rent.
Great. So there's a big, big tip in there. A lot of people will ignore it, but for the ones who take that advice, it can really set you up for long-term financial success if you don't overextend your house on the housing payment, no matter what you're qualified for.
Yeah, the ones I get nervous on or think that they, you know, can take it on is that, you know, they're paying $1,200 a month in rent. They have car payment, you know, they have a lot of discretionary debt, right? So you need a car because you got to drive to work. You may have student loans, you know, but then their revolving debt, you know, their Macy's card and credit card are coming up against their limits, and yet they feel that they can justify a $2,500 a month housing payment, you know? So they're doubling their housing expense, and they are taking on all of this other revolving debt, but they're quote unquote okay, you know, with the payment, and they, by the book, may qualify for it, but, you know, they're setting themselves up for failure.
Great. Let's talk about credit now. Basically, the better the credit, the better the rate. One thing I want to sneak in here before I let you go is that a lot of people who think they have bad credit really don't, right?
Yeah, I think for the most part, people that are looking to buy homes today do have pretty good credit. The ones that know they have bad credit, they're very upfront and honest about it. I think that, you know, flashback 10 years ago, 12 years ago, you know, it wasn't that way. It was, you know, everybody was looking to buy a house. You know, they had 550 credit, you know, currently delinquent on a, you know, on a credit card, but, you know, they were good with a $2,000 payment.
Yeah. Right. So obviously you're going to want to get your credit in shape because you're going to get a better interest rate, right?
Absolutely.
How low can you go? I have 580 there, but I didn't consult you first. What's a good benchmark people should be trying to hit before they think about?
You know, 580 is really the very, you know, it's not something that we really do much. There would have to been some, you know, extenuating circumstances there. So, for example, came out of the financial crisis, you lost your job, and, you know, you reestablished some credit, but you were so fearful of taking on so much new credit that you only have one credit card, but yet all of your, you know, your historical late payments are back from 2012 and 13, and your credit score is 580 to, you know, that 600 range.
Okay. So I amended that just now on the screen. So really you should be shooting for 6 or more, right? To have
Absolutely. And you know, if you're in that 620 even to 680 range, I would say you definitely want to live and die by that debt to income ratio not to exceed 43%. And again, it's also, there's, you know, some analysis there. If I'm looking at your credit and you have 700 credit score and you've been paying $1,500 a month in rent and you don't have any high balances on your credit cards and you're comfortable going to 2,000 and your debt to income ratio maybe is 45 or 46, then, or even 50, which the conventional, loans allow for as well, then, we are comfortable making that credit decision because you obviously can, handle a little bit more debt because you've been taking care of your bills, right?
Yeah.
And don't have other discretionary debt.
Great. And we have on the screen here, short-term credit analysis shows some opportunities for improvement. So you guys, James, I'm not going to say you're a credit repair, but basically you can help people improve quickly sometimes.
Yeah, what happens is some things pop up on your credit that you were unaware of, even with, A+ credit borrowers. The most common is a medical collection. The insurance company was supposed to take care of it. By the time, you talk to them and they got the check out to the hospital or the doctor, they sent you for collection. That easily can, be a 10-point swing. It's the holidays, right? So you're coming out of the holidays now and you ran up your credit cards because of it, and it's not, it's not the norm for your credit profile. So if you pay down some balances, your credit would go back over 700 or 740. Credit matters. So, really the way it works is on conventional loans, to get the best possible rate, it's credit score to loan to value. So depending on the loan to value that you're looking to borrow compared to your credit score, Fannie Mae and Freddie Mac, they have a chart that basically will say what is the premium that will be subtracted from the price of the bond, which in turn raises the rate. So the higher your credit score, and it's not necessarily the loan to value, it's more credit score driven, because if you have excellent credit and you want to put 3% down in a Home Possible or Home Ready, which are first-time home buyer programs through Fannie Mae and Freddie Mac, there is typically the rate will be the same for the person at 740 credit and at borrowing 80% loan to value.
Okay.
So the credit score really is the main driver in conventional loan programs.
Okay, and then a big point I think we can bring up here too. I just don't want people watching this to get discouraged, because the advisors at Bond Street, you and the other guys, are very good about staying in touch with somebody who might be in the fives right now, and we're, as a team, we're here to help you and give you the right advice so that maybe if you can't buy today, in a year or two you're ready.
Absolutely. Buying a home is a process. It's a journey. I've dealt with many people over the years that had a credit score in the 500s and said, look, and we're not a credit repair company, but just by analyzing credit to say, if you open some accounts, if you took care of these collections, which will help you do. I've seen in 6 months, people's credit score go up over 100 points.
Yeah.
And I say, if you deserve a mortgage, we're going to find a way to get you a mortgage, deserve being the key word. And so you do have to prepare, put your house in order to get there. And if we give you the direction and you follow it, we will absolutely be there with you all the way, step by step.
So don't close this webinar down because you think you have a 590 score and it's not possible. Just reach out, right?
No doubt.
Okay, so let's talk about the paperwork, because this is a lot of stress comes from this, and it's good to know what you got to get together. It can take time to get some of these documents. What paperwork are you generally looking for, James?
Yeah, so actually it's gotten much more streamlined, which is a good thing. Again, we're normalizing in the mortgage world. So if you're a W-2 employee, we really only need your last year's W-2 now. We don't need a 2-year W-2 and a current pay stub. We don't need your full tax return anymore if you don't own any other property, if less than 25% of your income is from commissions, if you're not self-employed. So if you're just a wage earner out there today, then your most recent W-2 and pay stub is all we need from an income perspective.
Wow, I didn't know that. So it's actually a lot easier than it was just a year or two ago.
Yeah, absolutely. It's gotten much more streamlined. Now, if you have bonus income or commission income or overtime, we will get a verification of employment from your employer and look at that 2-year history because we average overtime or bonus or commission. But yes, as far as submitting paperwork based on a wage earner, the current W-2 and current pay stub is all we need.
Great. And then I have a note here, be prepared for last minute requests from underwriters. This is normal. I'm just planting that seed in people's heads because this is the basic paper you need to get started for the pre-approval. But along the way, there's going to be some stuff.
Yeah, underwriters' jobs, they're auditors, right? So their job is to raise questions. So there will be, as well as we can prepare the client, an underwriter is always, they wouldn't feel they were doing their job if they didn't ask questions or clarification on things. So, little things that may come up, and there are a lot of checks and that are done at the underwriting level, a more deep dive into things like fraud guards, for example, checking names against databases. Things like LexisNexis, which takes a deep dive into collection and judgment history, previous address, possible ownership and other property. So, possible tax liens, because now, with a lot of the new credit reporting rules, more and more, judgments and collections, those type of things may not report on credit anymore. So they do come about in the underwriting level, and the underwriter will ask, for clarification on those things.
Yeah. So I just want people to know that this is going to feel invasive, prying. You might get a little, I'm taking it from my side, not yours, James, but just know it's part of the process as you go through it, and be ready to just know that these people are not trying to be your enemy. They're trying to do their job. There's a lot of money at stake here. It's hundreds of thousands of dollars, right? And they're just doing
I don't care who you are or how big you are as a mortgage lender or bank out there. We all answer to a higher authority. So, right. When you're dealing with Fannie Mae and Freddie Mac, they audit these files, rightfully so, when they're delivered. So something will come up in an audit, and we take a lot of pride in making sure, and of course, trying to keep it streamlined and making it the best possible experience for our clients. But we have to do our due diligence, and it is hundreds of thousands of dollars and thousands of loans a year. And we want to continue to do that and build a great reputation while, again, giving, the customer the best possible experience as well.
Right. So, and part of giving them the good experience, I have here the last line, a good advisor will minimize the last minute stress. If you're with somebody like Bond Street as you go through this process, just know that you're going to be prepared and educated along the way on what's coming next.
I've always taken a lot of pride in that. I know obviously, when they came out with the GFE changes in 2010, right after post-crisis, because of all the bait and switch tactics and things that happened, for us, it was a very easy adjustment because we took a lot of pride in giving people all of the numbers, all of the information up front. And, if we as a company or a team said, these were the numbers, that's what you went to closing with. So, absolutely. There is now, the GFE is no more. It's called a loan estimate, which basically combined the old good faith estimate and a truth in lending statement into one 5-page document. And now, by law, you're required to receive a closing disclosure at least 3 business days prior to closing. So we take a lot of pride in giving you all of the information and numbers up front. And in fact, it just happened today. We had a client that, was looking at their loan estimate and, where they went to, and the loan estimate had, I think, about $11,000 in closing costs, which closing costs include things like your attorney, the title company that you choose, and their fees. So there's a lot of things that are outside of our control that we do estimate, we do put on that loan estimate just to make you aware of those expenses. And they got their closing disclosure today, and it was $9,000. So, we actually overestimated because of the timing on taxes and that as well. So we take a lot of pride in making sure you know those numbers up front and everything that you're getting into. And I think if we just rewind for a minute and we talk about that pre-approval stage and all of this that's going into this pre-approval stage, that really makes the rest of the process easy. Yes, you could have issues with your inspection, things come up on the property, but really doing all of this, the process of the mortgage is really just exactly that. Signing some papers, going through the process, and getting you to closing, not having any curveballs, come up along the way.
Yep, great. So next we have down payment. A lot of people are going to wonder, how much do I need? It's all over, right, James? It depends on your situation, but how little can somebody get into a house for? Might be.
So yes, the Home Possible and Home Ready programs I mentioned earlier allow for as little as 3% down. And on those conventional programs, you can request a 3% seller concession. FHA allows for 3.5% down and a 6% seller's concession for closing costs. Gifts are allowed from family members. There are programs, each state housing authorities or housing agencies do have grant programs. So depending on what state you reside in, you can check at the state level. We'll be glad to let you know what might be available in your state as well. And in New Jersey, there's programs called like the Homeward Bound and the Smart Start that allow for a 4% forgivable grant as long as you occupy the property for 5 years. Of the loan amount, 4% of the loan amount towards down payment and closing costs. So if you combine that with a seller credit towards closing costs, you can get into a home with 100% financing.
Wow. Okay. So it is possible for this specific thing that, they're probably going to want to talk to you or another advisor at Bond Street and a local agent who understands these programs where they are, but they exist.
Yeah. And there are many grant programs that are approved through HUD that you can qualify for and use towards down payment and closing costs with just a standard FHA mortgage as well.
Great. Okay, so good idea to save. Obviously, the more you put down, you might get a lower rate. You might save PMI, for example, which is
the PMI is where it affects it. Although the Home Ready and Home Possible, what they've done there, a very good job with that, is that the insurance, the PMI is also based on an insurance factor. So the less money you put down and the lower your credit score or higher, that's going to change that insurance, that PMI premium that you would pay over, annualized, right, per month. But the good thing they've done there is that if you put as little as 3% down, the factor for the insurance is as if you were putting 10% down. So you do get the benefit of the lower insurance factor in the Home Ready, Home Possible program. And it's been a very good alternative to the FHA, because FHA, when you're doing max financing, the MIP, as it's called with FHA, mortgage insurance premium, is for the life of the loan. On the conventional side, once you reach 22% equity, the PMI does eventually go away. So the APR, on a relative basis, on the Home Ready and Home Possible programs is lower compared to the FHA loan. Now, if your credit score is lower, the FHA is going to be more advantageous because FHA is not as much. It's sensitive to credit scores, but not as sensitive as the PMI because the insurance comes through HUD through the FHA. And so that premium is constant. If you're putting less than 5% down, you're going to have a 0.85% MIP factor. If you're putting 5% down or more, you're going to have a 0.80 annualized factor. If you're putting more than 10% down, then the MIP will drop off after 11 years with the FHA.
Okay. My head's hurting. I'll just trust you on that stuff. Okay. All right. So let's keep going here. That's the down payment. So let's just talk quickly about shopping around for a mortgage. It does make sense, right? Obviously, you would love it if somebody came to you and they just never talked to anybody else and signed the paperwork, but you can shop around and get a better rate.
Yeah, I would say it's a big financial decision. Like any, if you're faced with a big medical decision, typically you're going to get a second opinion. It's always, people are going to shop, and that's natural. I'm confident in who we are as a company and our services. We take a lot of pride in being super competitive and in line with interest rates with our competitors. That's how you win business. And of course, we bring to the advisory side to the table and really help from that perspective. But
yes. Compared to some of the bigger companies that are running TV ads and things like that, you offer the same product line, of course, but the benefit somebody's going to get with a shop like Bond Street is that they're actually going to have probably somebody with a bit more experience and who cares a little bit more about the individual's case, right, than a bigger vendor.
Absolutely. I mean, many of the bigger companies, and obviously here at Bond Street, we want to we are growing, but we take a lot of pride in making sure that our advisors have a higher level of knowledge when it comes to the mortgage industry, products, programs, guidelines, than the average company. Because for me, that's the most important thing, is if I tell you, hey, Ryan, you're pre-qualified, I'm going to issue you a pre-approval letter, we're going to stand behind that letter 100%. You know, again, things may come up with the property, but we're not going to fail you on the mortgage side of it. And so when you deal with bigger companies, it's easy for them to say, well, you know, this department or that department, you know, let me get back to you kind of thing, where, you know, we're 100% accountable to our clients.
Great. Okay, so let's jump into the fun stuff. We intentionally started this in sorry, James, I'll call it the more boring, unsexy mortgage stuff because it is where you need to start. And you guys, you know, if you're watching this, you really need that information, and you need to have somebody like James on your side as you go through the home buying process. And you should probably talk to James before you even open up Zillow, right? So you really want to hammer that point home.
Yeah, absolutely. And look, they're all, you know, there's benefits to all of those sites. It's great today. You know, we talk about it all the time where, you know, not too long ago, the realtor controlled all the information. And now, you know, many clients are coming to you and saying, you know, hey, Ryan, I saw these 15 properties. When can I go see them? And you're like, what properties? And, you know, you're scrambling to set up, you know, showings. And so, you know, the information world obviously has given people access, which is a good thing. But, you know, the moment that you're serious, you want to make sure, again, that you're, you know, really focusing on the numbers, and then, you know, setting up your schedule and your showings, you know, your property viewings accordingly.
Right. So once you have the pre-approval in hand, you're probably going to start searching on sites as you go through that process. I'm just going to bring up a few points here. Zillow, one important thing that a lot of first-time homebuyers don't know is that Zillow actually doesn't have every listing. They work off of syndication feeds. Zillow can have listings that other sites don't have because a lot of the listings on Zillow are self-listed by the seller, but they'll also not have a lot of listings that might be out there. Craigslist, again, not every listing, but is a good place to find stuff. A lot of people will list on Craigslist. Realtor.com is more or less a mirror of what's in your local MLS system. So it's kind of every listing in your area that's listed by agents, but not necessarily, probably not going to have FSBOs, which are for sale by owner properties that Zillow would have. Another tip here, HUDHomestore.com is a pretty cool site if you want to find government-listed properties listed by the department by HUD. Sometimes you can find good deals there. And James, there's some interesting financing options with HUD too that you could explore with people, right? So you might find not only a good deal on a property, but also find some good options on financing.
Absolutely, and many of the HUD homes, you know, they require renovation, and HUD has a program, 203K, of course. Fannie Mae has a very good reno program called the Home Style Renovation Loan. So, you know, if you have an open mind and you know, you can see through you know, maybe a rundown property, but you can, you know, you have the courage to bring it back to life. There's on the 203K side, it works just like an FHA loan, 3.5% down of the total budget. So the purchase of the home plus the renovation, and you put 3.5% down plus closing costs. And the home style loan, you can actually combine a home style loan, Fannie Mae home style loan, with the Fannie Mae home ready loan. So you can actually do the same thing with as little as 3% down.
Great. So yeah, if you're brave enough to do a fixer upper, it could be a great way to set yourself up for instant equity and long term. Financially, those numbers can really ripple, right? If you get something that's 20% under market now, for example, you know, while the guy, you know, you're just setting yourself up if you're buying smart. All right.
No doubt.
All right. I'm getting a little lost there. So let's keep going. I have some search tips here, James. I'll jump in. FSBOs, which again is a for sale by owner. You might see a sign outside somebody's house and think that if you cut out the realtor and work directly with the for sale by owner, that you'll get a better deal. The advice I'd like to offer is that you're probably better off using an agent because there's a good chance you could say something directly to the seller that could compromise your negotiating position. Would you agree, James?
No question. That absolutely makes sense. Even on listed properties, Ryan, I think you would share the same sentiment. I've been involved in many, obviously thousands and probably tens of thousands of transactions at this point, but to me as a buyer, it really matters to have a buyer's agent. I know a lot of people go on Zillow and, they're looking to get a hold of the listing agent.
Right.
For me to have, for me, it's very important to have somebody that represents your interest as the buyer. To have, the listing agent, there's a conflict of interest there, and it should be separate. So, you want to find a good buyer's agent to work with. And you know what? You're not going to get a better deal by going directly to the listing agent. It's the fact of it. They want to get the price that they're listing for it. So they're not going to argue with themselves. They're not going to fight with themselves to get you a little bit better deal. I think it's a big misnomer. If I'm buying a house today, I want somebody representing my interest and only my interest and negotiate for me the best that they can with that listing agent. So to me, the buyer's agent is crucial in the home buying process.
Great. Some other search tips here, just some things that I like to tell people I know who are searching for houses, like keying in on price reductions and motivated keywords. I actually have my real estate license in Florida. Here's off of my site, for example. You can search on a lot of real estate agent sites for keywords like motivated. So it would be every property on the market where the seller is saying they want an offer fast. You can also quickly search for properties that were reduced recently. So you could ask your real estate agent, hey, could you email me every property that was reduced every day as that comes into the MLS? What this will allow you to do is maybe know faster about a property that wasn't a deal yesterday, but because of a price change becomes a better deal today. So focus on price reduced. Most real estate websites will offer that. James, this is a really fun topic for both of us. We talk about this a lot for first-time home buyers, considering 2 to 4 unit properties as a strategy. So you want to talk a little bit more about, why it might make sense for you to buy a property that has an income unit?
It's very common, for first-time home buyers to buy a multifamily as their first home and then hold it for a long term. I've seen that work very well. Obviously, you're going to deal with the tenant, but you're going to get the benefit of that rental income to offset the expenses. And, very often, first-time home buyers become, second-time buyers and then move into a single-family home, and now they have a rental property that's, they're using for cash flow. So it's a very good strategy. And, you can even buy, a 3 or 4 unit property and hold it as a long-term property. And, if you are going to go buy a home and you need to unlock some of the equity, you could always take a line of credit, make sure the numbers work, and that house can pay for itself. And you can, take out some of the equity to, let's say, go buy another investment property or go buy, another primary residence. It's a great strategy.
And I have here, you can also use the income from an extra unit to qualify for a higher price property. So say you're approved for 200 for a single family, and you're in a market where 200 doesn't get you much. You might find that taking a peek at the multifamily properties might bump you up to 250. Right, James, from a qualifying perspective.
Yeah. So if you renting that second unit for $1,000 a month, just to use an even number, you would get the benefit of $750 towards your monthly income to qualify for that payment.
Right. So definitely, if you're having a hard time finding a house, or if you want to build wealth long term in real estate, you can set yourself up by when you buy your first property, go for multi-unit. I have here foreclosures don't always equal a good deal. I know a lot of people want to see the foreclosure list. So a lot of times a foreclosure is going to be a can of worms. Just proceed with caution there. We'll just bring that up. I know that a lot of real estate agents use that offer, get a list of foreclosures. Just know you might be setting yourself up for more stress than you're ready for.
And there is a gimmick there too that we should point out, right? Because you go on Zillow and you see, oh, foreclosure. Right. Well, the reality is, they're kind of preying on people's problems. The notice of default was filed because they're 90 days late on the payment. And so you call the foreclosure specialist that's listed there, and, that property's not for sale.
It's not for sale yet. They still have to get foreclosed on. right?
Exactly. It could be a 2-year process. So again, I'm not a big fan of those type of gimmicks, but unfortunately, it's part of the laws of attraction when it comes to real estate search websites.
Yes, I know all about it. All right, and then fixer uppers might equal sweat equity. We just talked about that.
Yeah.
Really, if you've got energy, you don't have kids yet, maybe, you got time on your hands. I'm not saying but if you have the time and the willingness, really, really consider a fixer upper. It could be great for you.
And you know what? There's streamlined programs under the 203K and home style. If it's up to 35,000 in repairs for things like kitchens, bathrooms, and more cosmetic type things, flooring, paint, non-structural things that we've all, probably been through some type of that, where it's not the end of the world that you're living in the house and you're getting your kitchen redone or you're getting your bathroom redone. So, and kitchens and bathrooms, of course, add the most value to a home. So you find that older ranch that was built in the 50s and 60s, and the people are retiring to Florida. 35,000 may give you an extra 20 grand of equity when you're all said and done, because of just updating a kitchen and a bath.
Not to mention, you get exactly what you want from an aesthetic.
Yeah.
You kind of get to make it what you want and love it. Make it yours.
Get rid of the pink tile.
Yeah. Now let's talk about picking an agent. You touched upon this, and I think this is really critical. I've been an agent for a while, and I've dealt with a lot of people who are like, yeah, I was working with my cousin, but dude just wasn't, for whatever reason. A lot of people have real estate licenses, but not everybody who has a real estate license. Most people who have a real estate license really aren't in the game seriously.
That's right.
They're selling a house here and there. So while you have a cousin or a friend, they might not be the best choice. Also, mixing business with friends and family doesn't always work out the best.
I had an experience with a client that they were calling for a pre-approval letter, and they were working with an agent in an area that doesn't matter who, but because this is common, I'm sure you've heard of it. And they're first-time home buyers. They were coming from out of state, across the bridge in New York, and they were calling for a pre-approval letter. And I said, okay, how much are you going to offer? And did you like the property? Well, we didn't see the property. The agent said we should make the offer before we go see the property.
Yay.
Like, that's not how it works. I said, you really want to go see the property before you make the offer. And, they did take my advice. And, so you really want to make sure you're dealing with somebody that has experience. It's great to use a friend or family, I think, if they're in the business and they're serious about it and they do it full time. Of course, it makes sense to help them in their business, and I'm sure they would do the right job for you. But like I said, if they're not in the game, they're not going to be up to date, on the latest rules, regulations, and they're not going to be great at negotiating. And
they may not know the inventory.
Right. Absolutely.
You want to work with somebody who's out there every day and just off the top of their head can say, oh, wait, I know this house might be good for you for X, Y, Z reason,
Absolutely.
Another good point,
around and showing you things that, definitely aren't going to work for you.
Yeah. Another red flag to look out for. Now, a lot of, you might be really excited. You might see a house online and you might want to get in there immediately. So you'll call an agent. You'll be like, hey, can I see this tomorrow? Right. If the agent says yes, and they go out and show up there, they might still be a good agent, but you're probably looking for somebody who's going to give you a harder time about it. Right. It's counterintuitive. A lot of agents are going to ask you to sign a contract, right, James, a buyer agency agreement.
I think so. We are seeing that more and more, for the simple fact, like I said, I think, I know how hard it is, to build a business. And I feel that, especially with all of the online websites, people feel that I've seen this business has become more commoditized, right? So they have, again, in their mind that I got to deal with the listing agent. But I spoke to Ryan, and I've heard this story recently, and it's like mind blowing to me, and I actually feel bad about it. But it happens to us on the mortgage side as well. I work with a client, pre-approve them, and okay, our interest rates are the same, work with them for months, send them pre-approval letters on a Sunday at 4:00, that type of stuff. And, only to go under contract and say, well, I found this lender, online, and their fee is $200 less than yours. And I will make the argument that, look, I've put in the time and I believe I'm worth the $200. I can understand if my rate was higher or something along that lines. And so the same thing is happening to the real estate agent. It's, you go show somebody, agent recently told me the story. They went and showed a client 4 houses on a Sunday morning. And the wife turned to the husband and said, oh, well, Gary, we got to hurry up because we got to go meet that other agent at this other property.
Right.
I don't think people understand clearly that person is taking their time to show you. And look, if you don't click with your agent, it doesn't work out, you don't feel they're doing right by you, that's fine. But remember, everybody works on commission, and they're paid by the seller. They're not paid by you.
Right.
They are putting the effort, and they are working hard for you. I think as a client, you do owe them at least that decency and courtesy to let them represent you as the buyer's agent through the transaction. So I think a lot of buyer's agents are asking for that contract more, not necessarily that they want you to pay them a fee, but that you agree to let them represent you in your home search.
Right, and I think that's a good thing. You want to work with somebody. It's a very intense, short-term, condensed 1 to maybe 6 month relationship, and you want to make sure both sides are committed all around.
That's right. Yeah, and like I said, that's their livelihood. I actually had another situation where client went to meet a realtor at a property. The one realtor was waiting there, and another realtor showed up before the client got there.
Yeah. Open the door. Yeah.
Who are you? I know you're waiting for. And they, the one, I think they just laughed about it, and the one realtor had left because the one realtor had been working with them for a while, and she was, distraught over it. So I would just say to people out there, find your buyer's agent and work with that agent to, have them find you the property you're looking for. And like I said earlier, they are going to represent your best interest with, in negotiating with the listing agent.
Yeah, and it might not be, interview, if you're really somebody who likes to prepare, interview 2 or 3 people.
Absolutely.
See who you like.
No
and you could call any real estate agent and say, hey, I'm interviewing buyer's agents. Be very upfront about that. I'd like to come to your office and sit for 15 minutes and see if, and most good agents would say, yes, I'd certainly give you that time.
And many buyer's agents work with big listing agents, right? So they can even work as part of the same team, and the listing agent and the person that handles the listing, or the listing agent on that team, may have a lot of inventory for you, but even a lot of those big teams, that's why they separate it, because they don't want the conflict, and they want you working with the buyer's agent on their team. So it's important to have that buyer's agent represent you, and like you said, interview a few until you feel comfortable, and once you find them, then stick with them.
Great. Now let's go into negotiating now. Just some tips. I think this is a really big key tip here. If you pick the right agent, just listen to them, right? That's probably one of the biggest things a good agent can do for you. Sure, they can open the doors and help you find a property, but this is where lots of money comes in. It could be 5 figures, who knows, maybe even 6 figures when you're negotiating, and don't think you know better, maybe.
No doubt. And that's why, again, I will just hammer down that point. That's why it is important to have a buyer's agent, and because they are going to represent your interest, and you got to listen to them. They're the pros. They understand the marketplace, and it's amazing. You still hear it out there today, that people still have this, 2012 mentality where, the property is listed for 300 and they think they should offer 2.25.
Yeah. Yeah, coming in low can make no sense. You might have 5 competing offers, and you want an 8. Your agent might say to you, "Look, the listing agent told me there's some other offers coming in. I really think we need to be at 100%, maybe even bigger." And just know that they're not doing that because they're trying to get you to pay more. They're doing that because they want the deal to happen.
Exactly. They know very well, like you said, especially the pros and the people doing it full time. They know the price that house is going to go for, because they probably just negotiated 5 other deals in the area, and they have lost a couple. So they're looking at things in absolute real time. They're giving you the right advice.
Yep. Next thing with negotiating, terms can often be more important than price.
Yep.
for contingencies this always going to allow?
Especially when we're in this time of year, right? So when you're in the beginning of the year, especially the self-employed people out there, where you're filing your personal and business tax return. For a wage earner, it's not important because your W-2 is your W-2. It's issued by a payroll company that your income can be verified with your employer. But if you're self-employed and you're relying on your 2017 income now, that income must be verified with the IRS. So it's going to take a little time, even if you file your tax return today, for that to be updated in the IRS system. So it is very important that you set the right expectations when you're going under contract, and keep those type of things in mind. And we'll definitely, give you a heads up on that if that's the situation. But yeah, it's not just that you're getting, a great deal. It's that you're going to follow through. And especially if it is a HUD home or a Fannie Mae home property, or you're dealing in states where contracts are time of the essence contracts, then you're going to be in a situation that you're not going to be able to meet the time frames, and could cause possible issues.
Got it. Some contingencies to watch out for: the home inspection. I have here something always goes wrong with a home inspection. It's the home inspector's job to find what's wrong with the house, and just don't get freaked out. Welcome to home ownership. It's not the end of the world. Usually you can negotiate around the biggest things that are wrong with a property, and if you have a good agent, they'll help you either get concessions or get the seller to fix certain things. Just
if you're buying a 30-year-old home, you're going to find some things wrong with it, right? So the main things are the structural and the mechanics of the home. Those are the bigger things. But if you have a cracked sidewalk, or something along that lines, cracked tile, or little things that may add up to $1,000 or $2,000. Most sellers get it. They understand that, and they're willing to negotiate credits towards closing for those items. But if you're going to go into a 40-year-old home and thinking it should be in tip-top shape, it's priced the way it's priced for a reason. So yeah. You have to be realistic when negotiating those items.
Yep. So just go into the process all around, not just with the home inspection, with an attitude that you're not going to sweat the small stuff, or it's really going to be more stressful than it needs to be for you. Really, what's going to happen is you're going to get into your house, you're going to love it, you're going to forget about all these little things a month later. Right, Jay? It's just
absolutely. They're like you said, they're minor things that you can take care of either with the credit or on your own, over time.
Yep. Some other things in terms of as you go through the process, you have the property under contract. In addition to the home inspection, you're going to need to get title insurance, homeowners insurance. Really quickly, let's just explain what those are, James. Title insurance.
Title insurance protects you when you take over ownership of the property, that anything on the prior owners does not follow the property. You're the owner, and anything that would have otherwise possibly have come up after you took ownership that is related to a prior owner cannot be attached to the property. So the title insurance protects you from that perspective. And the homeowner's insurance, you are required to get a homeowner's insurance policy that does require a certain amount of coverage based on the value of the home and your loan amount. Something term that you'll hear when it's time for home insurance, and typically we wait for when you receive your commitment and an appraisal is in, because the appraisal will give an indication of the replacement cost value of the home, and that's typically what you're insuring on the homeowner's insurance. If you're in a flood area, obviously then you're going to be required to have flood insurance as well.
Right, and all of these costs for these different things will show up as you get your estimates with the mortgage company and go through the process.
Yep, absolutely. We run a flood cert before we disclose the loan, and if it is in a flood zone, I mean, most times now, obviously from the listing side, and the realtors know if the property is in a flood zone, and we have that conversation, try to find out what the current owner is paying for flood insurance, even if we can maybe get a copy of the declaration page, because one thing to consider there, and states like Florida and here in the Jersey Shore, is that the flood map has changed. So the zones have changed. So the current homeowner might have had a previous zone which required a less level of insurance, And now due to obviously, the hurricanes in Florida and even, Sandy here in 2012, those zones were changed to be higher risk. So your flood insurance coverage must be relevant to the flood zone map. So the homeowner might say, well, I only pay $100 a month, but that might have been because that's what the zone was, a less risky zone, and now is a more risky zone. So we can talk about, we definitely talk about that stuff up front, and, you can talk to some insurance professionals to give you an idea of what it might be. Could be a part of the property is in a flood zone, and you can pay for an elevation certificate, $500-600, and with that elevation certificate, presenting it to the insurance company, reduce dramatically the flood insurance premium as well.
Cool. And we're transitioning now into kind of the end part of the process. As you've got the property under contract, you've got those contingencies, the home inspection, the title insurance, the appraiser's gone out, and then we kind of touched on this before. You're going to have some last minute things to wrap up, right? Conditions at the
two major contingencies that come to mind are your inspection contingency and your mortgage contingency. Once you go under contract, officially ending an attorney review period, you want to obviously immediately get your home inspection done and go over those items with your attorney that you may want the seller to fix, or at least give you a credit towards at closing. Solve that. Once you clear that hurdle, then it's the commitment date. And the commitment, the mortgage contingency is that commitment that you are able to get financing, the two major hurdles, and then obviously the third is the closing date as well. And look, there's so many parties involved, right? And really, after the housing crisis, and more so even with new regulations, the mortgage company and the mortgage lender really has become the epicenter of the transaction. We are dealing with a lot of third parties, and so we need title binder and title insurance in order to have our underwriters review things like an updated tax cert, to calculate taxes and make sure that we're qualifying you at the right numbers. So keep in mind, there are a lot of moving parts, and we're not necessarily responsible for it. We're responsible for our side of it, and all of that has to come together in order to, meet the closing date. And so if somebody, is delayed, and for many different reasons, we talk about that inspection contingency. Maybe it's delayed. It's important for us to all communicate and make sure that, the dates are being adjusted to meet the new timeline based on any delays that might come up.
Yeah, you just brought up a really key point. The mortgage company does kind of become the center of it all with the action. You have the realtors, the lawyers, the title insurance, the appraiser, everything's moving around. And that makes it all the more important to pick the right mortgage company. If you pick I'll just say it, if you pick an online vendor, somebody you've never met or can't give you that level of intimate assistance, you could have a more stressful time here as you get closer to closing.
Definitely.
Yeah.
And the most important thing is, and look, we've all had transactions, probably have a couple going on now, that things get delayed, right? Sometimes we use, especially when we're talking about the, some of these bank statement investors out there, they beat to their own drum. There's no secondary market. They are the market. And so they, put you through the ringer. I always say, I've been, 20 years, and I'll communicate through and through the process. And our goal is to get every loan to closing on time. But the most important thing in the whole transaction is trust. Trust in us as the lender, in some cases as a broker, and in the team that we are going to see it through. Our goal is definitely to get it to closing. Unfortunately, sometimes because of unique types of financing structures, it's a little more painful for everyone involved because, the more time we spend on a loan, quite frankly, obviously the expense goes up, the time invested goes up. So we're not here to give anyone a bad experience, but if we're, there are outside factors that do come up in an appraisal, for example. Things may be brought up in an appraisal that nobody made us aware, and then we have to address it. And things have to be, have to happen, and that causes delays. Communication and trust. Those are the two biggest things.
Great. All right, James, I feel like we fire hosed it here. A lot of information came flying out at people, right? We're just trying to get it out there. I think, this is the kind of thing that you might want to share with other people you know are going to buy a house. You can watch this multiple times. But the biggest thing you can do, honestly, is just click the button near this video to schedule a consult, right? Talk directly with James or somebody on his team.
Absolutely. You can talk to one of our advisors, you know, in regards to a pre-approval. And, you know, look, it's a journey, right? So we're not here to, you know, get as much information out of you as possible, but we really want to have a full conversation so we understand your position and you understand your position, so that when you're ready to pull the trigger, again, the mortgage becomes secondary. You're going to be informed. You're going to have your documents in order. You're going to know exactly where you stand. You're going to sign that contract, and we're going to get you to the finish line.
Great. So next steps, click the button, schedule a consult. Once you do that, your mortgage advisor will walk you through the process of completing the formal application. If you don't already have an agent, we, just by the nature of what we do here at Bond Street, we know the good agents. We know who they are, right? So don't be shy about asking, like, do you know somebody, and let us know what area you're looking at. We could probably match you up with one or two buyer's agents who might be good choices for you. And finally, now you get to do the fun stuff, start shopping for houses once you got these other things out of the way.
Absolutely. We're here for you. You know, we take a lot of pride also. You know, again, you may deal with a big bank or a national lender. Our team is available 7 days a week. You're out there shopping on the weekend. You decided to, you know, go drive around some neighborhoods and you saw some houses you liked, and now you had some questions. You know, feel free to click the button, set a time. We'll or call our offices. You know, we're here as a team for you. 888-842-7347. That's a toll-free number that does ring to our whole team, and somebody will answer that phone 7 days a week.
Great. Okay. Thanks, James. Thanks, everybody, for watching. Again, use that number. I'll make sure the number is nearby and that there's a link nearby. We look forward to working with you.
Thanks, Ryan. Have a great day.
Yep, you too.
Bye.